you for joining me today for my live stream. Super excited. I'm in a different spot. So I'm actually in my Lodi office today. Don't have the cool green screen behind me, using my phone. So I won't be able to see comments. So if you have comments, post them. Anna's going to try and text them to me so I can respond to people live. If I can't, then I can't, and I'll just keep going. But I'll get to the comments later, I promise. If you're watching recorded, then I'll get to your comments later as well. This topic is really important right now. This topic is a big one because there is a lot of lack of awareness on the part of a lot of home buyers right now on really how competitive this market is. And so this video is, I'm creating it from the perspective of speaking to you, the prospective home buyer, and speaking to you about what your tactics need to be in order for you to purchase a home and how to successfully purchase a home today, because this market is not one that is easy to accomplish the process of getting an offer accepted. And so I'm going to provide tactics that are designed for the person that says, John, I don't just want to write offers. I don't want to just go look at homes and hope that I can get one accepted. I want to become a homeowner. And if that's you, this conversation is to you. If you're saying, you know what, I'll get a house if it works out, and if it doesn't work out, then it's no big deal. If it was meant to be, I don't want to force the issue. I don't have an issue with that. That is entirely your prerogative. But if that's what you choose to do, then I'm concerned that you're just going to be going through the motions. By the way, guys, I'm going to take a quick timeout and ask Anna a question, because on my screen it says scheduled. It doesn't say live. So I hope that I'm live right now. And Anna, if you could just confirm that I am live, then I'm good. But it doesn't say live because I'm connecting a different way, and it simply says scheduled. And I'd hate to be this far into the video and it not actually be streaming. So Anna, if we're not streaming, let me know. Shoot me a text. If we are streaming, then I'm just going to keep talking. Anyway, so here's the deal. It is, the media has it wrong. The media is clearly saying, thanks, Anna, for letting me know I am live. All right, so my screen steered me wrong. The media is leading you astray by telling you that this market is a challenging market, by telling you, the media's not saying it's a challenging market. The media is saying this is a buyer's market. And they're saying, look, interest rates are high. Not many people are wanting to buy homes. House prices are dropping. They're saying that because they're trying to sell clicks. They're trying to get people. Bad news sells. Good news does not sell. Well, the funny thing is, the truth is even worse news. The truth of the matter is right now that the market has way fewer buyers wanting to buy, but even fewer sellers wanting to sell. Why do sellers not want to sell? Well, it's kind of simple. They have a really good interest rate. Maybe they own the house in cash, paid it off, and they have no interest rate. The fact of the matter is, for the cash owners, they might be able to sell and move to another house and pay cash. But if they didn't have enough in value of their home to pay cash for the next one, they're going to need a loan. And interest rates are pushing upwards of 7%. And somebody who has a 3% interest rate today that says, gosh, I can sell my house right now and upgrade to a little bit bigger house, their property taxes are going up because in California, your taxes are tied to what you bought the house for. And so when you sell that house, you start over at the new price that you're buying the next house for. Your payment's going up significantly because you're going from your 3% rate to a 7% interest rate. So it is a huge increase in monthly payment for those people. And as a matter of fact, I heard a new phrase this morning I love, and it's called love the loan, hate the house. There are so many people in that category that love the loan, but they hate the house. And they know that they cannot take their loan from the house they're in that they hate to the house they want to that they love. And so they're stuck. They bought a starter home 5 years ago that they expected to upgrade, and they couldn't upgrade it because they can't upgrade it because they love the loan and they don't want to get rid of the loan that they love. So I'm publishing a video this afternoon, my weekly market update. And for those people who love the loan and hate the home, there's a way to press the reset button. And so check out that video this afternoon. I'll be releasing it on my YouTube channel. They'll get some good insight on how to press the reset button and actually buy a home that you love and have a lower overall monthly payment for a lot of people. But let's not focus on that. Really, what I'm focused on is the buyers and how to successfully navigate today's waters. And I'm seeing a tale of two markets. I'm seeing, and I'm talking about all over up and down California, that we're seeing the low to mid range of the market, and I'll use the Central Valley as an example. We're talking about houses priced below $600,000 or $700,000. They're gone. They're going super, super quickly. Why? Because that's the home that the first-time home buyers want to buy. And there's very few of them for sale because the move-up buyers, they aren't moving up for the reasons I just talked about. So that market is super hot, moving super fast, highly, highly, highly competitive. Now you got another market, and again, I'll call that the high-end luxury market. And in that market, homes are hit and miss. Some of the homes are flying off the shelves very, very quickly. Other homes are sitting a lot longer. And what I'm finding is that buyers are being a little bit more picky at the high end of the market. Ever since March of this year, banks kind of tightened up on the money that they would lend, and that's impacting the jumbo loans the most. So the high end of the market, it's not as hot as the lower end or the mid-range, but it's still case by case. Houses are moving super, super quick. So I want to talk to you about strategies to get your offer accepted. And I'll tell you, the first thing you have to understand is it's not always about price, but price is a big one. What you really want and what's most important is to have a realtor that understands the arts of negotiation. You've got to have a realtor that understands that you can't write a basic offer just like everybody else does and expect to get your offer accepted. And so if you need help with talking to your realtor about this, and I'm happy to give them some thoughts and advice, forward this video to them so they can see some of the things that I'm talking about that can help differentiate you. So the first thing is know your competition. Now you have two parts of your competition. One part of your competition is the other buyers that are out in the marketplace. So you've got to think about what are the other buyers thinking, what are they offering, and how can I be different than they are? But you have a second part of the competition, and that is the person you're negotiating with, the seller of the home. So you have to think about what are the seller's needs, and guess what? Every seller is different. So you can't assume that just because I know that, hey, if I was a seller, this is what I would want. That isn't always the case. So the two things that you can negotiate very easily is price and terms. Now, price is simple to understand. The more you offer, the more likely they are to accept your offer. But the problem is if you offer the most, but you have the worst of the terms, and I'll go through terms in a minute. If you have the worst of the terms, the seller's not going to necessarily pick you. Because in the mind of a seller wants the most money they can get with the highest chance they're actually going to get it. So if you have the highest priced offer, but your terms say, hey, I want to close in 30 days, excuse me, in 90 days, and I'm going to be contingent on the sale of my home, and I'm putting 0 down payment, and I want you to credit me 6% of the price of the home towards my closing costs. Well, your terms kind of suck. And so the seller says, you know what, a lot can go wrong in 90 days. So timeline is critical. How quickly are you saying you're going to close? Contingencies are critical. So there's contingencies I'm going to cover in a minute and help you understand what contingencies mean. And your realtor is the most important person to talk to you about this because I'm not licensed to give advice on the real estate contract. So I'm speaking to you as a friend and giving you some thoughts of things that I've talked to my friends about on how to be successful in navigating the terms that they offer on their loan, on their contract. So a lot of things we want to look at. So the first thing you want to look at is price, but you got to be careful because if you offer too much, the seller says, that's great, but you're not paying me cash. So the lender who's backing you, that would be me, has to do an appraisal. And my agent and I don't think the house is going to appraise for that much. And therefore, you're going to have trouble. You're going to come back to me in the end and you're going to say, hey, Mr. Seller, your house didn't appraise for what I offered, so I want to lower the price. Sellers are wise to this game. And so what happens, I've seen it happening more and more. We saw it in 2020 and 2021. It kind of went away in the last year to year and a half, and now it's coming back. And what's happening is we've got buyers increasing the price on the home, but the seller says, I'll only accept your offer if you waive your appraisal contingency. Now, an appraisal contingency says the contingency means I can cancel if there's a problem with this particular component. So the three main contingencies are loan contingency, inspection contingency, and appraisal contingency. And then sometimes you have the contingency on the sale of your home. So we'll talk about all of those as I talk through this part of the live stream. So when the realtor comes back and the listing agent comes back and he says, hey, I've listed the house for $500,000 and you've offered me $550,000. I don't see other homes that have sold recently for $550,000. That's why we listed it at $500,000. So I want you to promise me that no matter what the value of the home is, you're going to buy it. I want you to release your appraisal contingency. Because if you keep that contingency in place, you can go back to the seller and say, hey, Mr. Seller, I am not going to move forward with buying your home unless you lower the price or unless we negotiate. And the seller doesn't have to lower the price, but the seller can't keep your upfront deposit if you cancel when the appraisal comes in low. And a smart listing agent says, I'm not going to allow that. And so I'm going to ask you to waive your appraisal contingency if you're going to offer that high of a price. So be careful, because offering a higher price comes sometimes is what it takes to get your offer accepted. But sometimes it comes with the seller saying, I want you to waive your appraisal contingency. Now, that's a scary thing to do, because I base my loan on the lower of the contract price or the appraised value. But if you're putting a decent down payment, we have some strategies where we can show you how to still buy the house with the same down payments, even if the house value comes in lower. And let me give you some super simple math. So let's pretend that you were buying a house putting 20% down, and you were buying the house at listed at $500,000, but you're offering $550,000, and you're putting 20% down, so you're putting $110,000 out of your pocket, which is makes the loan amount $440,000. The seller says, "Hey, I want you to waive your appraisal contingency." Don't automatically say no. Don't automatically freak out and say, oh my God, I'm going to have to come up with my 20% and the extra money that the appraisal came in short. Instead, let's run some calculations. And that's where you pick up the phone and call me, and we do a three-way call with you, with your realtor, and with me. And the first thing I'd ask the realtor is, what's your worst case scenario on the value of the home? And if their worst case scenario, John, I don't know, it could be as low as the original list price of $500,000. I say, okay, let's pretend it is. So you're buying the house for $550,000. You're putting $110,000 down, so you're borrowing $440,000. But if the appraisal came in at $500,000, which is your worst case scenario, what I would do is I would simply say, then in my eyes, and you're not putting 20% down, you're putting 12% down. Because your down payment shrinks from the $110,000, it shrinks to $60,000 down, or 12% down. You're still writing a check for the $110,000. The other $50,000 is covering the shortage on the appraisal. The only difference is you pay a little bit of a one-time fee for mortgage insurance. Think of it as low appraisal insurance. So it might be anywhere from 1 to 3% of the loan amount. That's way cheaper than you coming up with 150 grand. Because in that math, most people think, well, gosh, if the house came in at 500,000, I still have to put 20% down, which means I got to put 100,000 down and I have to cover the 50 grand. John, I don't have 150 grand to come up with for down payment. Plus you got closing costs. So all we're doing is adding a little bit to your closing costs, and we can find a way to make that work. So releasing an appraisal contingency isn't as big of a deal as you might think, provided you have a decent down payment. Now, the less you have for down, the less room we have to make that work. But there's a couple other strategies that I have that we can talk one off. If you have a smaller down payment, as long as you're not using down payment assistance, if you have a smaller down payment, there's still some strategies that we can use to basically at least limit your exposure. Because that's the other thing you can do, is you can put in the offer, instead of saying, I'm waiving my appraisal contingency, you might say, I'm willing to pay up to $20,000 over the appraised value of the home. Now remember, if somebody else waives their contingency and you set a limit and said, hey, I'm only willing to pay $20,000 over, the person who waived their contingency is going to win. So a waiver of an appraisal contingency, if you have at least 10% down or more, is rarely as big of a deal as you think it is. But people really freak out, and it takes a three-way conversation with you, your realtor, and me to talk strategy. And sometimes you might want to go in from the beginning waiving the appraisal contingency. If you have a big enough down payment, I've got some buyers right now that are offering, $1.2 million on a home, and they're only borrowing $700,000. They're putting $500,000 down. It doesn't matter if that house is worth 1.2 or just $1 million. They're still going to be borrowing a very small percentage of what the house is worth. They're still got a big amount of room between the value of the home and what we're loaning as a loan. And that's what matters. So appraisal contingency is something that isn't as big of a deal if you have a decent down payment. If you're using down payment assistance, it's a super big deal. And you would have to have some way to cover that difference out of pocket, a gift from family, something like that. So that's appraisal contingency. Loan contingency is another one. Loan contingency is basically your ability to say, hey, John King goofed up. Now, John King does everything possible to make sure he doesn't goof up. Let me be clear. I'm also human. So things happen, I didn't see something changed from what we originally talked about, or there was new information that came to light. So every once in a while, we can't complete a loan. I've got to tell you, it's probably been 1.5 years since I started a loan that I couldn't ultimately close. Once I start something and I've got you pre-approved and you're in contract, there might be times we have to change things up, but I make sure we get it done. And we can help make your offer stronger by having your loan fully underwritten before you write your offers. But the truth is that still doesn't guarantee you're going to get the loan. There's still things the underwriter doesn't see or they have to refresh. The only difference is the underwriter is trusted more than I am, because the underwriter has the authority. And so when the underwriter says it looks good, it's really no different than me saying it looks good. It's about who's got the right amount of knowledge. And a lot of loan officers, they don't have really good knowledge, or they don't really care. And so they just say yes to everything. I don't do that. But if it's necessary, in a lot of cases, it's just not necessary, but it's a good tactic. I'm going to call one of my buyers this afternoon who wrote an offer on Tuesday, and the offer, the competition came in significantly higher than what the house was listed for. And he wrote his offer $25,000 above the list price, and he still lost out. So he's talking about having the flexibility to write even higher offers. And I'm going to be talking to him this afternoon about, hey, let's get your file into underwriting, because it really does two things. A, you can feel a little more confident releasing your loan contingency up front. I feel pretty confident in most cases that even after I'm the only one that's reviewed it, you can still release your loan contingency. And I'll tell you whether I have concerns or not. But B, What it lets you do is to write a shorter escrow period. Now, for some sellers, this is where knowing your competition matters. For some sellers, they don't want a short escrow. They still got to finish cleaning out their house. They've lived there for the last 30 years. They got to get the dumpster to clean everything out. And they don't have the time and they don't want the pressure. So for some sellers, a quick escrow is a negative. Although you could offer them what's called a rent back. And you could even offer them the rent back for free. By the way, if you're watching live, feel free to post any comments into chat. I'm streaming from a different location, so I don't have the same video set up. So if you have a question, Anna will send it to me via our internal Teams chat, and I can see that pop up on my screen, and I can answer the question. Otherwise, if you're watching recorded, I'll go back in and answer the questions later. But if you have any questions, any thoughts, any feedback on what I'm talking about, I would love to hear it. So please feel free to post it in chat, whether you're watching live or watching recorded. So timeline. How long you write for the escrow period. You can write a short escrow and offer the seller a rent back. As a matter of fact, you could go so far as to say, hey, I'll give you a free rent back. You can rent back the home. I would allow rent back for up to 59 days. Because to be owner occupied, you have to move in by the 60th day. But you could offer the seller a free rent back. Now, did you have to give it to them for free? No. But in some ways, it's better than increasing the price of the home. So maybe you're not the highest price, but you're giving them extra time to get moved out. And for some sellers, that extra time is more important than a little extra money. Now, yeah, it costs you money because you're making a mortgage payment during that time, but it's probably costing you less money than what you might have had to offer to be the highest price. So for sellers that need time to move, offering a short escrow, a 15-day escrow, and then saying, I'll give you 30 days after that to live before you have to move out rent-free, gives them their money quickly. It gives them peace of mind that the transaction is going to close, but it gives them time to get everything ready, time to find and get settled into their new home. That's something that you can offer as a way to make the terms of your offer look better. So we've talked about appraisal contingency, we talked about loan contingency, we talked about close of escrow period. Shorter close of escrow periods are critical. In some cases, I can allow you to offer as short as a 10-day closing. We can move from start to finish in 10 days. Now you got to pay for a rush on the appraisal. There's some extra cost associated with that, but if that's what it takes to get the offer accepted, it's often well worth it. Okay. All right. So as a reminder, because I saw another, I see now there's more chats. Oh, Beth Logue said hi. Perfect. I was going to say I can't see it. So Beth, thanks for telling me, Anna. So Beth, hopefully you're getting some good information. Beth is an amazing realtor. She probably already knows everything I'm saying right now, and she does a great job of coaching and mentoring other realtors. So thank you, Beth. All right. So talked about appraisal, talked about loan contingency, talked about close of escrow. Let's talk about inspection contingency. Your inspection contingency has nothing to do with me. Now, the appraiser has two things that the appraiser looks at, the value and the condition of the home. But the appraiser's condition review is simply a matter of, hey, these things are health and safety hazards or make the home unlivable. Now, even if you waived your appraisal contingency, it doesn't mean those things don't have to get done. It simply means that the seller doesn't have to do them. Now you're saying, John, and you know anything about real estate, you're like, John, this doesn't make sense. If it has to get done, but the seller won't do it, how do we get it done? We get it done by using something called an escrow repair holdback. So on most loan programs, I can hold your money to pay for those repairs, and then we close escrow, and then we do the repairs afterwards. Now, it depends on the type of repairs that need to be done, depends on the dollar amount of the repairs. So this is not carte blanche approval to do that, but 9 times out of 10, any repairs that are called out on the appraisal, we can have done after close of escrow. We just get a contractor's bid, and we hold back 1.5 times that bid amount of your money, and we will use that to pay for the work to be done after close of escrow. So that's how we deal with an appraisal waiving the appraisal contingency, but the appraiser still having issues with the property. Now, when you do your inspections, that's a home inspection, a roof inspection. By the way, your inspection contingency also covers paperwork. It covers you reviewing any CC&Rs, you reviewing what school district you're in, what the flight path is for airplanes nearby, and how close you are to a local railroad track. All of those things are part of your inspection contingency. And the inspection contingency says you can cancel without losing your deposit money if you find a problem in the inspection contingency that the seller is unwilling or unable to resolve for you. Now, again, I'm not a realtor. I'm not licensed to be a realtor. If your realtor says that the inspection contingency means something different, they're right, I'm wrong. But that's my understanding of it, and I think I'm right. So waiving the inspection contingency, that's between you and your realtor. And you could go in with no contingencies at all. That certainly is the strongest offer when it comes to contingencies. Now, the final contingency is the contingency for the sale of your home. That, hey, I own a home and I need to sell that home in order to buy this one. There are some ways we can avoid that. I've got a program called a bridge loan that can take money out of your current home and loan it to you for a few months so that you can buy the next home, move into it without having to sell your old one, and then sell your old one and pay back your regular loan and your bridge loan. And the cool thing is you make no payments on the bridge loan. The problem is the bridge loan comes at a higher interest rate and you cannot tap into all of the equity in the home. Matter of fact, you're typically only tapping into a total of 75 to 80% of the value of the home. So bridge loans don't work in every situation, but they work in a lot of them. That's a way that we can help avoid having to do a contingency on the sale of your home. Give me 1 second to take a little bit of water. Okay. So what other things can you do to make your offer stand out? One of the things that you can do is to look at who pays for the other related fees on the real estate transaction. There's a spot in there that we talk about who pays for the home warranty, who pays for the transfer tax, who pays for the escrow and title insurance. Oftentimes, those are split 50-50 between the buyer and seller. You could turn around and say, hey, Mr. Seller, I'll pay all of those fees. Now, the funny thing is somebody may be offering a higher price, but that higher price, the home has to appraise for that higher price. But you can get the seller more money in his pocket or her pocket by paying some of those fees. You're accomplishing the same goal of getting the most amount of money to the seller. But what you're not doing is you're not raising the price to give the seller risk that the deal might fall apart if the house doesn't appraise. Excuse me. So that's another thing that you can do, is to look at the terms. And if you want to strengthen your offer or have the strongest possible offer, say, hey, I'll pay all title and escrow fees. So now if you're offering a strong price, you're waiving your contingencies, and you're paying all of the title and escrow fees, there's not a lot that somebody can do to beat you, but there's a little bit more. And it comes down to who you're working with to do your loan. Because if everything else is equal or pretty close, the seller and the listing agent are going to look at, do I trust the people in this transaction? That includes your realtor. So who you're using as a realtor matters. Whether your realtor has a good reputation in the marketplace matters. Who you're using as a lender matters. Whether your lender has a good reputation in the marketplace matters. So the theory, and I'm going to be careful how I say this because I'm a benefactor of it, the theory is agents are more leery of internet lenders because they have nothing to lose. A big internet lender has no local reputation at stake. They can say yes to something and it falls apart at the end. They have nothing to lose. I have a reputation in this market. If I say yes and later on I end up most of the time not being able to deliver, it's real quick that my realtors stop referring me and listing agents stop accepting my offers. So I have skin in the game. I have something to lose if I'm saying I can do something and not being able to deliver. A step above that is proactive communication from your lender. I will call the listing agent every time you write an offer. That's key to the listing agent feeling good about accepting our offer. It's not going to make you win if your price is significantly lower than somebody else's, but it is going to help push you over the edge if everything else is equal. The final thing I want to talk about is seller credits. You've got to be very careful in a market like this asking for seller credits. I'll tell you the best time to get a seller credit is right before the seller is going to lower their price. The problem is, how do you know that? That comes to trusting your real estate agent. It comes to your realtor having a good understanding of market conditions and understanding that, hey, if I was the listing agent on this transaction and, big banks, Beth said big banks too. So not only is it internet lenders, but it's big banks that have a bad reputation as well. Thank you, Beth. I appreciate that. Beth and I both have a history with big banks. I won't go too deep into that, but that is true. Very, very, very true. So when you are, now I lost my train of thought on what I was just talking about. We were talking about the loan officer you're using. Darn, Beth got me talking about big banks. So Anna or anybody else remember what I was just talking about? If not, I'm going to go ahead and fill in. We were talking about, seller credits. That's what it was. So seller credits are, you want to time it based on when the seller was about to lower the price. So if you've got an agent that understands the market, your agent is going to say, what would I do in this situation if I was the listing agent? This house has been on the market for X amount of time, and there hasn't been a price reduction in that amount of time. Or maybe it's been on the market for what, there has been price reductions, but it's been a while since the price has been reduced. I'm pretty sure, your agent's pretty sure that that listing agent is telling the seller, you need to lower your price. Now, the seller might be resisting and saying, I don't want to lower my price. That's the moment, that exact time is the moment to swoop in and say, I'll pay you full price on your home if you give me a 3 or 6% credit towards closing costs. Let's pretend it's a $500,000 home. You said, I'll give you the full $500,000 if you would give me a credit for 3% of the price, or $15,000. Now, the seller in any situation might say, oh man, I wanted my full $500,000. I'm not sure if I want to accept that because I'm really only getting $485. But in the case where the seller is thinking about lowering the price, there's a good chance the seller was thinking about lowering it even more than that. And they're saying, you know what? Or even maybe they were thinking about lowering it by 10 grand, but they're saying, well, I was already about to lower the price by 10 grand. 15 grand isn't really that big of a deal. But more important, sellers are emotional human beings in most situations. Now, everybody's an emotional human being. But a seller that is selling their own primary residence, they have an emotional attachment to that home. They think that home is worth more because of all the special things that they've done. And so by you offering them the full $500,000 without them having to lower their price, they get to tell their friends and family, I got my $500,000 for my home. I was right. My house was worth that. I told you that I could sell it for that much. Because the $15,000 credit, it's not public record. None of the seller's friends or family are aware of the fact. Hey, Lan, thanks for saying hi. None of the seller's friends or family are aware of the fact that they didn't lower the price, but they gave a concession or they gave a credit towards closing costs. So when you've got a seller that's emotional, that feels like this house is better than what the actual market does think it is, you have an opportunity to give them an out, to help them accomplish their goal, which is, I think my house is worth $500,000, and you let them sell it for $500,000. They just needed to give you a credit because you need the credit to make your loan work. That's what the magic is understanding the circumstances of your seller. And I'm going to take that one step further. Because sellers are emotional, a couple of things you don't want to do. You do not want to lowball them on a new listing because the seller is confident that's the price. So if the house just went out on the market and you're offering them a low price on the home, or you're offering them full price, but you're asking for a credit, the seller is likely to say no out of principle. So be careful about that piece. The second thing is even on a house that has been sitting for a while, and you say, you know what? I'm going to take John's advice and we're going to write an offer on this house that's been sitting for a while without having a price reduction. And it was listed at $500,000. And so I'm going to ask the seller to lower the price to $495 and to give me a $10,000 credit. The truth is that's exactly the same math as having them keep the price at $500, but give you a $15,000 credit. It's exactly the same math as asking them to sell it to you for $485 with no seller credit. But the worst thing you can do to a human seller that this was their home is to add insult to injury. What do I mean by that? You've injured them already by offering them a lower price on their home than what they think it should sell for. And now you want to insult me by having me pay your closing costs too? Now that's not logical, that's emotional. But people are emotional. You have to understand your competition when you're in a negotiation. Now, if it's an investor that had it as a rental property, if it's a bank-owned property, if it's a flip, they don't care about that. They're just worried about the dollars. But if it's a person who's lived there, or if it's a person who's selling grandma's house, they're emotional about it. You have to understand that about your competition. Do not ask for a price reduction and a seller credit, or at the very least, because I'm not telling you can't get that, but understand your likelihood for success is higher if you ask for one or the other, not both. When you're asking for both, you're adding insult to injury, you're pouring salt in the wound, any number of different analogies that I can come up with. But the fact is, sellers are emotional. You have to understand that. Here's my final piece of advice. Sellers are afraid too. Yeah, sellers are afraid. Sellers are worried that, hey, I want to get moved on to this next phase in my life. And I'm afraid this deal's going to fall apart. And so you've got an opportunity to use that to your advantage. I don't think it's a negative. I don't think I'm being unfair. But I think we have to, in a negotiation, use whatever tools we can to help ourselves stand out. So where does that come into play? First of all, if a seller was in contract to sell their home, they've mentally sold the home. They've mentally cashed the check. They have mentally moved out. And now the deal falls apart. The buyer cancels. The seller is devastated. All of their worst fears just came true. And you can be the knight in shining armor. You can ride in on your white horse and say, hey, I will offer you everything you just thought you were getting, and I will close in 15 days. But you got to be quick. You have to be the first one in right after that deal falls apart and it goes back on the market and you're ready. So if there's a house that you loved and you lost, do not give up. Try to offer a backup offer. That means that, hey, I'm in backup position. If this one falls apart, come to me. If you can't, or if they won't, or you choose not to offer a backup offer, be ready if the property comes back on the market to strike and strike quickly. Because the seller's already agreed to that price. They've already received the check. They've already moved out. They just want to finish. And their fear is they won't ever be able to sell their home. That something's going to change, that rates are going to go to 12%, and that nobody's going to want to buy houses anymore, and they won't be able to accomplish their goal. So understand that as an opportunity. Here's the other side of the opportunity. This is actually how my wife and I got the house that we bought 2 years ago. As a matter of fact, this coming, was it Monday the 31st or Tuesday the 1st? Anyway, right, I think it was 31st. The 31st of July in 2021, we moved into the house that we're in right now. And when we wrote our offer, it was spring of 2021, we wrote the offer in April. And it was a highly, highly, highly competitive market. So we did all the things that I talked about here. We wrote no contingencies. We wrote a short escrow period. We didn't offer a rent back, but it didn't sound like the seller needed that. Actually, we did give the seller a rent back, as a matter of fact. But here's the other thing we did. We gave the seller a short amount of time to respond. Now, the realtors on here will say, John, that can backfire. They can say, I'm not going to respond. You're right, it can backfire. But let me tell you a quick story about what happened with the house I was buying. We went to see the house, I think it was on a Friday afternoon. Maybe it was a Saturday morning, I don't remember. But all I know is that the seller, the listing agent said, yeah, we have more buyers coming up from the Bay Area, you know, that unicorn Bay Area buyer that's going to pay all cash. And they're coming up to look at the house on Sunday. And I thought, you know, we've lost out on some other houses and I don't want to lose out on this one. I personally thought that the person who, those people coming up from the Bay Area, they were likely to offer a higher price on the home. So I wrote all of the terms that I wanted to write, all as strong as I possibly could. And I gave them until 6 o'clock on Saturday night to respond. Pretty sure we wrote the offer on Saturday morning. So they literally had 8-10 hours to respond. It certainly, but maybe it was late Friday night we wrote the offer, so it was 24 hours, but yeah, I was pretty sure it was Saturday morning. The normal contract says, I believe you have 3 days to respond. We shortened it significantly. We found out at 8 o'clock that night our offer was accepted. As we went to do our inspection, the listing agent was there and he had commented and he said, you know, your strategy paid off. And my realtor and I and my wife were there and we're like, what do you mean? And he said, I told the sellers that we should hold off. You know, that yes, your offer was written with a deadline of Saturday night at 6 p.m., but I thought that we had more stronger offers coming on Sunday and that they should hold off and wait until Sunday. And he said the sellers were nervous. They were nervous because they really were ready to move and they wanted to make sure that they got an offer and your offer was super strong. And they also didn't want to have to leave the house on Sunday for people to come visit. They were a family, 2 big dogs, grandma lived with them, had a couple of kids in the house, mom and dad. They had to clean up and get out of the house every time somebody was coming. And we gave them an opportunity to spend Sunday at home. We gave them an opportunity to not have to figure out what to do with the dogs and to get everybody out of the house. And they're tired. They're tired of the stress. They just want it to be over. And it was a strong offer. And I gave them a really short amount of time. And their fear that A, they might not get a stronger offer and this one's going to go away. And their desire to just have a nice Sunday at home without having to get out of the house to let a bunch of people walk through the house. That's how I won. You've got to think outside the box. If you want to win an offer in today's market, and it's going to get worse. Because as interest rates start coming down, and who knows when, you watch my video that's coming out this afternoon, I talk about what my thoughts are on rates as well. But once interest rates come back down, this problem is going to get worse because we still don't have enough inventory for the number of people wanting to buy. In the 2007, 2008 Great Recession, builders stopped building for about 10 years en masse. We got way behind in the number of homes that needed to be built for the number of people that needed homes to live in. And so the inventory problem is going to take a long time to solve itself. The only reason why we don't have a major hysteria right now is because rates are up. But as soon as rates come back down, this problem is going to get worse. So whether it be today, so I'm recording this in July of 2023, or whether it be a year or two from now and rates are lower, the competition is going to get even stronger. And you have to decide, do I want to be a home buyer or a home offerer? Because you can spend all day, every day, writing offers on homes, but you have competition. You have people that want that home and they're willing to do things that you may not be willing to do. So you have to decide, how much is it going to hurt me or cost me today versus what's it going to cost me if I don't? Am I never going to buy? Am I never going to accomplish that dream of home ownership? Am I going to give up all of the savings I get from being a homeowner and have to live in fear that my landlord's going to kick me out because they've decided now it's time for them to sell the home or to let their uncle live there? Do you want to be in that situation, or do you want to be a homeowner? Because if you really, really want to be a homeowner, you have to decide to take steps that other people are not willing to take. The things that I talked about on today's call, I hope that you share this with everybody that you know. If you're a real estate agent, you should share this video with every single buyer and prospective buyer that you have. Because whether they're using me or not, if they're not using me, that's their first mistake. Although they did make a good choice by using you. But whether they're using me or not, these strategies matter. And if your lender doesn't understand how to help you navigate those, then you need to use me. But the fact of the matter is, you have to decide, am I going to become a homeowner? Or do I just want to tour homes and kick tires and write offers and complain about how hard it is to get an offer accepted? The choice is yours. And I don't care which one you do, but the fact of the matter is, if you really want to be a homeowner, you're going to have to take seriously the things that I've talked about today. So I really appreciate everybody joining me. I appreciate you joining us every single Friday. By the way, this Monday, the 31st, I am doing a webinar about the new Dream for All program. So the second version is coming out. We're going to get more news this fall, but I'm doing a webinar on Monday night, the 31st, from 7 to 8 p.m. talking about how you should be getting yourself prepared now. I've got some insider information about things that I'm hearing that they're considering. And so I want to share some of that with you come Monday night. So if you want to join, just email us. You've got john@johnloanking.com or kingteam@johnloanking.com. Our link is typically down below. Anna will make sure that you have it. But just make sure that you're joining us on Monday night if you are not already signed up. Really, really important if you're thinking about the Dream for All program to be there. Aside from that, hope everybody has an absolutely wonderful weekend. Call me if you need anything, and we'll talk to you soon. Bye-bye.